So you've decided to add reading to your New Year's resolutions. First of all, congrats. Allow me to recommend some financial books into your queue for the year. Today I have 8 different books to review with you, briefly, and hopefully add some finance education or refreshment to your reading this year. Perhaps you have somebody you're trying to convince to get on the financial freedom train. Some of these books may be great to recommend to your friend. After all, financial freedom and financial education is the backbone of achieving Minerva. Welcome back to Achieving Minerva, the podcast. I am Sal, your host. Before we delve into this, I will be forthright in saying that I am a unique creature and I am very self-aware of that. I love nonfiction reading. Several of these books I'm about to recommend may end up being about as interesting as putting sheetrock on a house to many of you. However, some of them I think are absolutely crucial to power through, even if you find them boring. And I will do my best to say if I feel like this is a must-read or more of a recommendation if you, for some reason, get a jolt of nerdiness sneak up on you throughout the year. So here we go. The first book that I am going to say is The Millionaire Next Door by Thomas Stanley. Now, if I was teaching an entry-level personal finance class, be it in high school or to adults of any age, this book would be required reading and probably the first book I recommend. If you plan on giving generational wealth down to kids, I'd encourage you to make this required reading prior to disbursement. This book gives a data-driven look into the facade of what rich appearing, usually high-earning individuals really is. Rich is hardline defined as individuals with net worths of $1 million or more. This book was written in 1998 and was updated in 2010, so inflation has changed the applicable numbers a little bit, but the theme is still applicable. This is an excellent introduction into understanding that people who look rich probably aren't, because if we can see your wealth and your cars, your house, and your things, then you probably don't have any actual wealth in your bank account. And that to actually become, and stay rich, really rich with your bank accounts, you're going to need to live below your means. Notably, many traditionally high earners, like doctors and lawyers, are only income rich, but asset and wealth poor, because society has dictated for years that new cars and 2 big houses were necessary to be a successful person. Meanwhile, your neighbor who owns a plumbing business is likely to be swimming in assets because, for one thing, he spent maybe $10,000 on his training and likely less instead of $300,000 or more like your lawyer or doctor friend. And for another, he knows how to manage his monthly budget a little better because he's had to for so long. This book does not go deep into the particular investment strategies, but it is a good introduction into making your spending budget less than your income. And if you can increase the difference between spending and income in the correct direction, you'll be a millionaire eventually. A lot of data analysis and good content is in this book, a lot of charts and tables. Excellent introduction, but in a very not condescending way. This will likely be one of the first personal finance books I require my children to read. So the second book would be the second book that I recommend if I was teaching a class. That is Dave Ramsey's Complete Guide to Money by Dave Ramsey. So again, if I was teaching an entry-level personal finance class, this book would be required reading, probably second. If you plan on giving generational wealth down to kids, I'd also encourage this one to be read prior to disbursement. Now, Dave Ramsey is not without his criticism on the FinTwit or other finance worlds, but he is excellent at a couple things. First, he helps a beginner change their perspective on money. His no debt policy is something I personally subscribe to, and I encourage others to subscribe to, even when the math says otherwise. For me, it's more of a psyche thing. I prefer to have as much cash flow free for discretionary spending and not locked into payments. I hate owing people anything, and I want my stuff to be mine with no question. So even if it makes mathematical sense to have low interest debt while there's a bull market going on, to me that constitutes timing the market, and I just prefer to pay cash. And Dave Ramsey definitely helps with that. And newbies absolutely should be paying cash and avoiding loans and debt anyway. So we at the Minerva household, we just have a mortgage. The second thing Dave Ramsey does very well is explains money vehicles and other financial topics in a very easy and simple to understand terms. Things like insurance and retirement accounts, interest, all made complete sense to me starting out because there's really not a whole lot of financial jargon in the way that he explains these things. His background in real estate helps make the chapter on buying a house make complete sense to a newbie as well. Now, all that being said, I would not call myself a complete Dave Ramsey disciple because there's two major things that I diverge from his teachings on. The first is the investment strategy. Ramsey seems to push actively managed mutual funds in this book very hard, and I fully disagree, as does basically the entire FIRE community. Passive, low-cost index funds reign supreme. And the other thing that I diverge from Dave Ramsey on is the hardline no credit cards. There are excellent reasons to discourage newbies in the personal finance world from using credit cards in any capacity, especially if they are starting out with a pile of credit card debt. And even if you're somebody that is 18 and hasn't really had time to have a lot of credit card debt, definitely try not to use them until you have a handle on your personal finance with cash. But credit cards can be great if you pay off the statement balance every month. It's also important to realize that you do need a credit score to effectively navigate today's world. And a good way to do that is to have a credit card that you just pay for gas and pay off the balance every month. Get one with no annual fees and rewards that fit your lifestyle, and boom, you have free money. Financial freedom is awesome. So to sum up for Ramsey, lots of good up until the investment strategy, and this is also an excellent place to start and really change your perspective on money. The third book that I wanted to review was The Psychology of Money by Morgan Housel. Keeping with the theme of if I was teaching a beginner class, this one would be required if time permits, depending on how long the class is. This book is among the newest on this list. It was published in 2020. Morgan Housel makes an excellent point here that is often forgotten in finance education and finance circles. For 90% of the people in the middle class, their issues with money is not mathematics, it's the psychology, their mental relationship or emotional relationship with money. He has 20 chapters that correlate with 20 articles that he wrote in his column that he had before the book, and he just dives deeper into these articles on different psychology of money topics. One of the reasons the two previous books are essential is that for someone who is new to personal finance, whether fresh out of mom and dad's house or have been blindly, quote, adulting for 15 years already, they need a change in their psychology of money because they probably don't have a great one to start with. They need to learn how to make money, stop being at a critical level of need, and how to harness the power of money to work for them and make the daily grind of life easier by stockpiling an adequate amount of money. Next on the list is Quit Like a Millionaire by Christy Shen. Now, Quit Like a Millionaire surprised me a lot because I was not expecting to get much out of this book because I frequent all the FIRE blogs and forums, and I have a pretty good handle on the framework on the FIRE movement and basic personal finance in general. But Quit Like a Millionaire changed how I really planned the FIRE, the retiring early part of personal finance. So this is the first one on this list that is more geared toward the retirement and actually what to do when you have saved all this money. So this would not be required for an intro class to personal finance, but I would highly recommend it if you are either one, in a financial situation where you're ready to start investing in IRAs, brokerage, etc. Because like I said, I disagreed with Dave Ramsey's investment strategies with the active mutual funds. Christy lays out a better one. And you are just now starting your first big boy or big girl job with retirement accounts, this is also a good way to learn how to set up your asset allocation. And number 2, about midway through your accumulation phase or further, and you're ready to start looking at how you're going to withdraw your money in a tax-efficient way, Christy walks you through how to set up a good, solid portfolio using passive index funds and how to set up each account in the most tax-efficient way. Christy pays $0 in taxes now that she's retired, and she walks you through her math on how to do that. This is not tax evasion. Christy paid all of the taxes she was required to while she was working, and this is completely legal tax avoidance using rules in the tax codes that are already there and are completely legal. I personally plan to reread this book later to refresh my brain on how to withdraw the savings efficiently. Now, for all the praise that I just gave it, there are 2 caveats. And one is Christy is Canadian, and that means she only knows the American system from an outside perspective. However, to her credit, her research is very apparent that she really knows her shit on both sides, the US and Canada. So kudos to her for being, quote, bilingual, because as she points out, the United States makes the nomenclature insanely difficult and confusing for pretty much no reason, while Canada's terminology just makes better sense. The other thing about the Canadian flavor is when she's laying out her portfolio, she has more of her allocation in the Canadian market than most Americans probably want. This is her defense of that. Home country bias is a well-documented tendency of investors to overweight their domestic market. Now, before you accuse me of scolding Americans for thinking they're the center of the universe, we all do this. Surveys show that investors all over the world prefer investing in their own countries, holding about 75% of their equity allocation at home. This is understandably because people tend to invest in markets they're familiar with. In America, you can't turn on the news without hearing about the daily performance of the Dow or the S&P 500. But you've likely never heard of the TSX, the Toronto Stock Exchange, or the FTSE 100, the London Stock Exchange. America is the world's biggest economy, and there's no question about it. So for Americans, the majority of your equity holdings should be American. However, that doesn't mean you should ignore the rest of the world. She goes on in a later paragraph to say, if you live outside the United States, avoiding home country bias is much more important. America has been the undisputed economic powerhouse since World War II, and if Americans overweight their domestic economy and get it wrong, they won't hurt their portfolio too badly. America is number 1, and at worst, they'll fall to number 2. Big deal. But for countries with smaller economies, the effect of overweighting domestic equities can be devastating, even though the temptation of investing patriotically is strong. So she defends her decision to have a heavy Canadian market allocation very elegantly. But she also admits that the U.S. is the market powerhouse, and the average person should be fairly heavily, if not totally, invested in the American market, especially if you are American. The second caveat to this book is that Christy and her husband are very anti-homeownership, and you may find that many millennial fire bloggers are also anti-homeownership, as a contrast to some of the older personal finance folks like Ramsey or Jim Cramer or Susie Orman. Christy is all in on the traveling expat fire lifestyle, and she is absolutely living it up, so kudos to her. I have an earlier episode on homeownership that you should listen to. In it, I can see that home ownership is not a mathematical win in finance, especially in the year 2023. But homeownership does fit certain lifestyles, and you'll find that some of the original fire bloggers, like Mr. Money Mustache, did end up becoming homeowners. It just isn't financially efficient, particularly if you live in the United States. So, to sum up, Christy's portfolio breakdown is awesome, and her post-fire tax strategy is very easy to understand and is great guidance. I would highly recommend this book if you are in on the fire train. And even if you don't plan to retire early, her breakdown of the Trinity study and her asset allocation is still very in-depth and useful. So book number 5 is a very short book. It's called The Richest Man in Babylon by George Clason. This book is basically a parable. It's about 80 pages long and is at about a 5th grade reading level. But it is still an excellent book to have in your toolbox. You could even introduce personal finance to younger children with this book. It teaches the very basics of investing using a metaphor of an ancient man investing in builders and farmers, etc. I would highly recommend that you spend an hour and read this book and share it with your young kids. I said that Millionaire Next Door would be the first book. Really, you could even introduce this book when they're like 10 years old. And they would totally understand the very basics of, like, when they get birthday money, spend some, save some, and eventually you'll have enough to help let that savings pile make more money. So book number 6 is The Random Walk Down Wall Street by Burton Malkiel. Now, we are getting into a little bit more of the extra credit reading material if we're using the if I was teaching a class metaphor. A Random Walk Down Wall Street is a book for the nerdiest among us. It's quite dry and boring. However, if you are someone who is contemplating day trading or even just trying to play the crypto bro or annual trading game, please read this one. A Random Walk Down Wall Street explains through the metaphor of a random stroll down a literal shopping strip called Wall Street how random the stock market actually is. Even if you take your stocks like Meta, Amazon, Microsoft, or Google that have been mainstays at the top for a decade or so now, while you can reasonably expect these to be decent long-term holds in the 2020s, predicting the day-to-day of even these stocks is kind of a crapshoot on if they will be up or down for the day or week and by how much. If you've ever ventured down the rabbit hole of day trading, you'll find that the day traders never have any idea what tickers are going to be winners or losers until minutes before the bell. And even then, they are only right about half the time at best. Those traders have no idea what companies they are trading, just the tickers. This book explains why that is, and the answer is that the stock market is completely unpredictable, especially in the short term. But even in the long term, individual stocks, even Amazon, are huge risks. One day, Jeff Bezos could turn into Elon Musk and go crazy, and Amazon stocks start plummeting, a la Tesla. Just be careful with individual stocks. Due to the sheer randomness of the individual stocks, it stands to reason that funds that passively track indices are the, quote, safest option because they rely on long-term, decades or more, and the market as a whole has been up over time 150 years. This book explains, albeit indirectly most of the time, why index funds are the superior investment option for average Joe. Book number 7 is The Bogle Effect. This book is pretty new. It was published in 2021, and it's by Eric Balkunas. I literally just read this book last month in December of 2022, and I really found it fascinating and came through it respecting the late Jack Bogle all the more. This is a biography of Jack Bogle, the man who started Vanguard and essentially invented the low-cost passive investing strategy currently used by over $1 trillion in global wealth. Index funds are overwhelmingly the investment vehicle of choice that is preached to layman investors all over the world. If you really like biographies and learning about the finance industry, I'd recommend this book, but it definitely isn't a required reading for understanding investing or personal finance models all that much. The last book, the number 8 that I wanted to share with you guys is The Fables of Fortune by Richard Watts. This book was really cool, and it's a short read. It's about 150 pretty small pages. Fables of Fortune is about the gluttony of money, in contrast to The Millionaire Next Door, where a rich person is defined at 1 million. This book defines rich as 100 million or more. And this is Richard Watts' defense of that definition. Quote, who qualifies as super rich? Forbes magazine has suggested the classification of super rich requires a net worth in the excess of $30 million. The magazine defines net worth as a family's liquid financial assets. In other words, cash and investments, not including homes or other non-liquid assets. In my client's world, having $30 million in liquid assets doesn't make you super rich. That level of wealth requires putting a limit on spending. I define the super rich as those who never have to ask themselves, can I afford this? Their net worth is such that almost anything money can buy is within reach at any time. They inhabit the economic stratosphere. In a sense, they spend their days shopping at the mall of life without ever looking at a price tag. This stratosphere is rarefied indeed, a financial altitude attained by either inheritance or remarkable luck, the VIP lounge of planet Earth, the place where only the super rich gain entry, an exclusive enclave most of us cannot begin to comprehend. For the great majority of us who deal in denominations of hundreds or thousands, the thought of hundreds of millions of dollars boggles the mind. To join the fraternity of my clients, you would typically have a net worth of $100 million or more. I consider such people to be super rich. To get an idea of how wealthy these individuals are, let's assume they earn 3% per year in passive income. That's $3 million in, quote, mailbox money, coming in every single year. My clients earn more in a year without working than someone making $50,000 per year will earn in 60 years. Only about 20,000 individuals on Earth have this kind of net worth. That's a pretty select group out of 8 billion. Just to make it clear, let's look at a few examples to contrast the rich from the super rich. Randy's company nets about $8 million per year from his international furniture production business. His operation stretches from facilities in Vietnam and China to several in the United States. However, Randy has made very few investments outside the business, choosing instead to use most of the company's profits to further expand his own enterprise. If this company fails, his sole source of income will dry up. When the remainder of his non-business assets is sold, the resulting cash and savings would not produce enough to maintain his current lifestyle. However, if he were to sell his company tomorrow and properly invest the proceeds, he would receive an average income of about $1.4 million per year. After taxes, he would have between $700,000 and $1 million of net spendable income. Most of us would wonder who couldn't live on $1 million a year. But in Randy's case, he couldn't survive financially. His $18 million home and accompanying $12 million mortgage, plus his four $250,000 or more automobiles, generate a burn rate of about $120,000 per month, not including household needs, travel, clothing, entertainment, and other expenses. In order to stay within the new budget, Randy would have to greatly reduce his spending, sell his home, and learn to live more modestly. By our new definition, quite different from the usual one, Randy is not truly wealthy. In a sense, the demarcation between those who are poor, rich, wealthy, and super rich is somewhat relative. If Randy decided to take some of his chips off the table by deliberately corralling his extravagance and living in a home with no mortgage, he would be able to reduce his dependence on his company and maintain a fairly high level of wealth. End quote. So this book could serve as a neat, quote, sequel to The Millionaire Next Door because it shows what's behind the veil of the mega rich people. The lack of joy, the unhappiness that they truly have, even with all the money in the world. It helped me differentiate from wealth that I can realistically build, which is like $3 to $5 million in my lifetime, and still be able to live a perfectly comfortable lifestyle, versus the astronomical wealth that only comes from sheer luck, inheritance, or an insane work ethic and business savviness. And it reinforced why I don't really want the latter anyway. That example of Randy not being able to live on $120,000 per month is insane to me. I don't even make $120,000 in a year. And there's no way I would be able to even fathom how to spend $120,000 in a month. So that was a list of 8 books to get you through the year. I hope that you pick up at least one of them. Some of them are pretty short reads, but several of them are really, really important if you are first starting out or you need to kind of rejuvenate your financial thinking. And I hope that these summaries kind of helped pick one out for you. Until next time, follow us or go to our website for some written content. We are currently working on some YouTube content as well for some visual content. But most importantly, please share, subscribe, and tell your friends about us so we can all achieve Minerva together.